But let's say I'm wrong and it gets all the way to 50. Many of my friends think it's just going to go through 50 like a hot knife through butter, the old cliche. It may, but I have a hunch it's going to stall out at 50. Yeah, so there's a lot going on. So we've got momentum, we've got price, we've got interest, we've got all kinds of chatter on Twitter. All the silver guys have come out and started talking. A lot of them are giving these real wild projections. I'm a little more conservative than that, but I think we're on our way. What's the gold-silver ratio going to end up at the top? That remains to be determined. But I think there's a lot to consider here with what's going on.
In today's news recap, what has triggered the breakout rally in silver? Since the beginning of June, silver has begun to catch up with gold. On Monday, silver prices held firm around $36.40 per ounce, hovering near their highest levels since 2012. After crossing $35 per ounce, the highest level since February 2012, silver's price hit its highest point in 13 years. According to most industry experts, the gold-silver ratio falling below 100 could have triggered the silver price spike. Thanks to the bull run in gold, the ratio has stayed around 100 since January 2025. But the long-term average for the gold-silver ratio has been around 70. So either the gold price had to fall or the silver price had to move up. Eventually, silver prices shot up, and today the gold-silver ratio stands at 93, with the gold price at $3,411 and the silver at $36. The big slump in the gold-silver ratio seems to have triggered the bull run in silver now. To get the ratio back to its long-term average of 70, the silver price must rise to $48, while the gold price remains unchanged. Alternatively, the price of gold must be correct. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, turn on notifications, and check our new Numismatics handbook. Most stackers want to get active, but swapping their metals for dollars isn't an option. There's plenty of opportunities in the overlooked numismatics world. Mastering U.S. coins, key dates, and errors pays off by multiplying your ounces and capitalizing where others aren't paying attention.
Smart money, if you want to call them that. The bullion banks, the commercials, the people that really know how these markets operate because they are operators of these markets, they will get to a point where they're caught short. And it happens very rarely. What they'll do is they will step aside and they will not basically put on any contracts. I'm using a broad brush here. It's not exactly this, but it makes the thought process more clear. So they step aside and don't do any shorting. And so now the market's driven by the funds and the retail market. So now it'll exhaust without them in participation of it. So now the price goes higher and higher and higher, but there is no retail buying, but there's some, but very little. But the the trading funds may be buying, but eventually it'll exhaust. So they waiting for it to exhaust, and then it'll start to come down. Now, since they can print money to infinity, once that momentum starts on the downside, they'll pound it. They'll come in and start selling like crazy, knowing that that momentum has changed in their favor, and then they'll start to really. So now what happens is the funds will have to start exiting, probably at a profit. Let's say they're long at 35 and price goes all the way to 42 and then it exhausts. Then at 42, the banks know, okay, now we've got momentum has changed. We could start shorting. So it's short at 42, it goes down to 41, short more at 41. The bank was in at 35 and now it's at 41. So let's take a profit here, which is more selling. Selling on top of selling. The banks are shorting and the funds are long and they're selling to get a profit. Those trades have to match. If somebody wants to buy it at 41, there aren't many people. In fact, there are none. No one wants to buy it at 41 on the way down. They'd love to buy it at 41 on the way up. So now what happens? The next match is $38 the ounce. I'm exaggerating for effect. So that's where you get the gap in the chart. So no one wanted to buy it at 41, but a lot of people wanted to sell it at 41, but they don't match. So now the next match is at 38. Again, I'm doing it for exaggeration, but that's why you get a gap in a chart. Happens in corn, happens in wheat, soybean oil, cotton, cocoa, doesn't matter. It happens in the commodities markets. But this is what drives me nuts as far as the futures markets, and I'm not against them. I'm just against them being used in the manners that they've been used. And it's not just in silver, although silver's the stellar example. I mean, there's more, paper shorts in silver versus the actual reality of the physical market than any other commodity by far. In fact, it's in the metals by far. But nonetheless, am I predicting, a big sell-off at 42? No, I'm just outlining how the futures market works and why you don't want to get too excited if you don't have that retail pressure on the market. Now, let's look at the other side of the coin. And actually, the most important side is investment demand. That's the swing factor. That's what is ebbs and flows. That's what makes a market a hot market or a bear market. It's the margins, the people that buy silver for investment. But 60% of the market is industrial, and that doesn't go away. It can ebb and flow, but mostly it's pretty steady, and the trend is clearly higher and higher.
In today's news recap, will gold prices continue to hit all-time highs in 2025? Gold prices have rallied significantly this year, climbing as much as 30% year-to-date when they peaked at $3,500 per ounce in April, surpassing J.P. Morgan Research's previous forecasts. As markets weigh policy uncertainty and geopolitical risks, what is the outlook for gold prices in 2025 and beyond? Earlier this year, we examined the structural shift in gold's demand and geopolitically influenced pricing drivers fueling its rebasing higher, ultimately posing the question if $4,000 per ounce is in the cards, said Natasha Keneva, head of global commodity strategy at J.P. Morgan. To answer the question, yes, we think it is, particularly now with recession probabilities and ongoing trade and tariff risks. We remain deeply convinced of a continued structural bull case for gold and raise our price targets accordingly, Keneva added. J.P. Morgan Research now expects prices to average $3,675 per ounce by the final quarter of 2025, rising toward $4,000 per ounce by the second quarter of 2026. Now we'll show you the best clips of the latest interview. Don't forget to like, subscribe, and turn on notifications so you do not miss out our daily recaps. And check goldsilverstacks.com to get your Stacker's Handbook, the ultimate guide to stack gold and silver, packed with strategies to trade the gold-silver ratio and get more ounces and build wealth over time, so you don't have to rely on market commentators to make your investment decisions. Enjoy the episode.
But let's say I'm wrong and it gets all the way to 50. Many of my friends think it's just going to go through 50 like a hot knife through butter, the old cliche. It may, but I have a hunch it's going to stall out at 50 and then consolidate and maybe come back and go through it. But it's tough to look at all aspects of the market. And if we had investment demand, if retail wasn't buying and they're not, but institutions were, and they're coming in, and this big pension fund bought, $50 million worth of silver, and another pension fund bought, $200 million worth of silver, and hedge fund came in and bought, 50 million ounces or something. If those things were happening, I'd be much, much more confident that, we're going much, much higher very quickly. But until this short paper situation is resolved, which is I just explained how quickly it can be resolved, I'm just going to hold my positions. I'm not going to add. I'm just going to wait and see. I mean, I really would rather give out news and tell you the institutions are coming in hand over fist like the banks have in the gold market. Silver doesn't have that luxury that it's considered to be a monetary metal by institutions. It's sort of the mavericks. It's the one-offs. It's the free market thinkers. It's the people that can think on their own or are willing to take, let's say, a higher risk for a higher reward, because that market is much smaller than the gold market. And if you really want to talk turkey, let's mention platinum. I mean, the commercials are long in platinum. Now, with the commercials long in platinum, that gives me um, more conviction that platinum's still going to keep running without too much resistance, at least for a while. But the commercials are not long in silver. They're very short. So anyway, I think I gave you hopefully enough to think about, Patrick. I'd love to be telling a different story, and love to be proven wrong. I always trusted David, and now he's telling me this, and that's not what happened. And it's going to go where it's going to go. I mean, maybe there's some, big deep pockets on the other side, the trading funds that have more, what they call dry powder, meaning funds, money, capital to put into this market and really squeeze the shorts for a long time. I doubt it. I follow these markets for 4 decades, and I don't see that out there. But we do have that kind of that unknown, and that's China. With the Shanghai Futures Exchange, and more physical going to China through China, and being in the futures market in China, and that's a factor I won't ignore. So I'm not going to discount everything I just said. I just want to say it's a tougher market to analyze, but it's also in a spot where could I be wrong? And yeah, and what would be that factor? It'd be the unknown. It'd be what we don't really know about the Shanghai Futures Exchange and the amount of demand that they may be exerting on, let's say, the Western banking cartels or elites that are very much winning most of the time in these markets.
What do you think of Morgan's take? Do you agree that the silver market is dead and this is just a silver squeeze? Is platinum still massively undervalued and buying hard assets is a smart way to protect your savings? Or do you think this big reset scenario is overblown? Post your honest opinion in the comments section down below and share your gold and silver price predictions with the Stacker community. Now check out this next video right here because it's the perfect follow-up for you. I'll see you on the other side.